never lies. Oh, one more thing. Let's go back up for a second. Okay, there is a question window on your screen. Now, we're expecting about 170 people in class tonight. There's no way that I can answer questions coming from 170 people. I also do not entertain questions that aren't directly related to tonight's webinar. Okay, now at Alvexa, we want to make sure you get answers to all of your questions. But if you have a question that's not directly related to tonight's class, please go to www.alvexa.com, use the live chat button, and somebody will be glad to answer you right on the spot. Now, like I said, with 170 people or more coming, I can't carry on personal conversations with somebody or answer your question because I'll never finish the class. But asking questions is kind of important because sometimes I do bad things. Sometimes I talk too fast. Sometimes I don't explain an issue or a concept well enough, or sometimes I skip over things. So if I find that lots of people in the class are asking the same question, that means I didn't do a good job. So I will go back over that issue or that question and answer it for you. Now, all of your questions are logged in with your email address. If they are related to tonight's class, tomorrow somebody from our financial analyst department will email you a specific, an answer to your personal question. If it's about the webinar. If it's not directly related to the webinar, please contact customer support at alvexa.com and they will be glad to answer your questions. So let's get on with price never lies. Now, first we have to talk about what price action is. Now, I've been training traders for, I've been giving webinars for 11 years now. I've been teaching for almost 20. And everybody I meet, especially since online trading grew, and we have all of this stuff with all of these advanced HTML charts and everything, most people want to ask me right away about technical analysis. What indicators, what oscillators, okay, what trading system, what things can I do to give me a good trade? Well, ultimately, I answer them, the only thing you should be looking at is price, because price never lies. You should be looking and trading from price on your chart. Oscillators and indicators are tools. Indicators actually do exactly what their name is. They indicate something. They are secondary, or even one step farther removed than price action. Okay. The price on your charts should tell you everything. That combined with a couple other basic tools on your charts should tell you what price is going to do or what price wants to do. Now, adding an indicator to help you interpret that price can help you. Don't misunderstand me. I don't have any problem with indicators, but they shouldn't be your first line of defense. Imagine, and I'm good for giving stories. Imagine you're at the UN and you're the French consulate at the UN. And there's a speech going to be given by the Belgian guy. And he's going to give it in French. But he's going to give it in, Belgian, French, Flemish, whatever it's called. Okay. And you want to make sure you want to understand all the nuances of exactly what this guy is saying. So you put your headset on and you listen to the interpreter in your ear, who is an expert at doing exactly that, hearing what he's saying and translating it into the proper French so that you're getting the right understanding. And that's exactly what an indicator does. So think of them as that interpreter whispering in your ear to make sure that you just don't miss something. So price action trading is a method of trading where the traders make decisions about trades based on price movement rather than on indicators derived from technical analysis. Price action trading is a strategy based on the movement of prices rather than indicators or analysis. Now, there are many different price action strategies you can use, such as candlesticks or breakouts, chart patterns. There's many different things you can use. While many traders use price action trading, it is still not a one-size-fits-all technique. you should practice before trading real money. Now, I myself am a price action trader. Okay. If any of you come to my classes before, yes, sometimes I'll drop MACD because I love MACD onto my chart. Sometimes I might put Bollinger Bands on my chart. Sometimes I might add an RSI or stake it, only when I'm having a problem understanding what I'm seeing. But my charts always have certain things on them. And that is my number one issue with price action trading. And the most important thing that you can do is have your support and resistance levels on your charts, because these are crucially important price levels. Now, if you think of support and resistance like the steps on a ladder, and as price goes up and down through those steps or those floors on an elevator, you know the important floors and this that the elevator will stop at. And these are historical. These are not drawn on your charts today and looking forward. These come from where price reacted at this level in the past. And putting these on your charts is time consuming when you don't have them. But once you get them on your charts, they just flow forward into the future. So they'll always be on your charts. But to me, this is support and resistance becomes one of the most critical pieces of information you can have when you're looking at price action. The second thing that is important is market structure. Okay. Are things like, I'm a true triangle trader. I look for triangles and I look for where we're going to get a breakout of a triangle, because I'm only looking for a breakout. When I get the breakout, and I don't care whether it breaks up or down, when I see price pushing into the apex of a triangle and getting ready to break out, then it's very important, because then I can look at my support and resistance levels to see where the next target could be. But all of this is based on price movement, no interpretations, no mathematical calculations. Price is telling you what it wants to do. If you combine that with volume and use volume to confirm what price is telling you and what the other traders are looking at, you've got yourself a pretty hefty, successful trading system. Now, the other thing you're looking for in price action is you're looking for how well the price movement is developing. The better you have, let me get my marker on here, the better you have price movement, the more defined. Like here, we started an uptrend. Look at this beautiful uptrend, push up, push. Now, it's not developed enough to say we have a strong uptrend, but look at the euro. It has been up to 107 now quite some time. Okay. But it's a very well-developed, nice movement. Okay. Here we had movement, but we had a mess. The more qualified your movement is, the better or the more high probability trade you're going to get out of it. Now, the fact is, lots of people try. The markets are messy. Price is a mess. Price is completely random. But there are certain times that price does have non-random behavior. And that is during uptrends or downtrends. And when price is exhibiting this non-random behavior, you can make educated trading decisions, because then you understand what price is doing and what to expect next. Okay. And like I said, most of the time, the markets are a mess. Price, and now this is a live chart. We're not looking at some JPEG that somebody's put together so it looks like. This is the live chart of the euro today. Okay. Now we can see, and I'm not here recommending a trade. I teach from the euro US dollar chart every day. Okay. This is my teaching chart. But it happens to be that we have this beautiful uptrend that's developing for us. Can't seem to get my marker to turn off. Hold a second. Now, again, we look at it in a 1 hour chart. We see something messy. See, like this was not a now that was a steady upward movement, but it wasn't a well qualified trend. And even this shorter term period here is nicely developed. But see, this, even though we had push E's, push E's, push E's, which we should have, we should be making higher highs and higher lows, higher highs and higher lows. Okay. When you have that, like I said, we've moved over to non-random price movement and we're interpreting price. Now, a lot of us can also add in to this certain candlestick patterns. And I'm not talking about looking for 3 white crows and 3 black soldiers, 3 whatever the reverse, or 3 I'm looking for engulfing patterns and reversal patterns. I'm looking for things to develop like a doji developing right on my support level or my resistance level. Okay, I'm looking for engulfing candles or something at strategic levels, because what I'm trying to do is interpret what price is trying to tell me. I'm listening to that guy at the UN and I'm trying to understand exactly what point he's trying to make. So we want to be able to look at price and understand what it is saying, what it's trying to do, and what it would like us to do. So some traders make decisions based on price movements of an asset. This is the premise of price action trading, following the movement of price and trading the actions they think are most profitable. Most price action traders don't use technical indicators such as moving average or Bollinger Bands. But if they do, you should give them very little weight in the trading decision process. A price action trader believes the only trustworthy source of information comes from the price itself and its movements. If a stock is beginning to climb, it shows that investors are buying because price rises as traders buy. They then assess the price action based on the aggressiveness of the buying, the historical chart, support and resistance, the real-time price information such as bids and offers, and volume. We also have things like velocity or speed of the movement. Okay. Preferred tools for traders are breakouts, candlesticks, and trends. They also use theories such as support and resistance. Traders use these tools and ideas for developing strategies that work with their preferences. Now, if you notice, the things we're talking about are not complex concepts. They're not things that you have to spend forever mastering. What you have to do is put them together on your chart and then spend the time mastering how to make your decisions. What clues you want to have. You know, somebody once described it to me as when you're not trading, you're evaluating, you're sitting on the sidelines, you're in the bleachers, you're not part of the game. When you enter a trade, what are you doing? It's the worst part of a trade because you're taking on risk. That's all you do when you enter a trade. You don't make profit until you exit. So the most important part of trading is the exit, because that's the only time you have profit. Now, the question though is always, the first question always is, do I want to make a trade? Okay. Is this have a potential of making profit, whether it's buying or selling? Once you've answered that question, then you have to ask yourself, at what price am I willing to take the risk? So, for example, assume a stock has traded between $10 and $11 for the last 20 days, and then moves above 11. This change in tendency alert traders that the sideways movement has possibly ended and a possible move to $12 might have begun. Now, breakouts occur from many different patterns, including ranges, triangles, head and shoulders, and flag patterns. Basically, as I said, I'm a triangle trader, and I lump flag patterns, wedges, anything that's got two lines coming in together as an angle and an apex, I call it a triangle. Because I'm only looking for the breakout. A breakout doesn't mean the price will continue in the anticipated direction, and it often doesn't. These are called false breakouts and present a trading opportunity in the opposite direction of the breakout. Now, this is a clue. you have a triangle and price breaks out upward, how do you know that it's going to continue rising? Well, there are clues you look at. You look at candlestick pattern, you look at volume, okay? But once you put together your support and resistance, your trade, okay, you have to make a trading decision. So at some point you have to say, yes, I'm going to buy that asset, or no, I'm going to stay on the sidelines making no money, or I think it's going to go any other way. Now, breakouts can be small or large. When you're looking for small consolidation in short periods where the price moves sideways, breakouts during a trend can provide excellent potential opportunities. Now, candlesticks are graphical representations on a chart that show the trend, open and close, high and low of an asset. Traders use candlesticks in various strategies. For example, when using a candlestick chart, some traders use the engulfing candle trend strategy. An asset can be trading throughout the day with prices continuing to climb or fall. Traders refer to these as fluctuations as a bullish trend, where the price is rising, or a bearish trend when the price is dropping. As many of the decisions associated with price action are subjective, what one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical analysis, where you effectively ignore all the experience of the investors in favor of cold, hard trends. Human nature dictates that futures and commodities prices can be extremely volatile. Now, I live by the belief that to trade for price action and to trade successfully, to get high probability trades, trading must have started to move in a trend. Okay, a push, an ease, a push, and an ease, and a push, and an ease. Okay, I don't want to get out here. I don't want to get in here. All I want to do is get in around here and take a little profit and get out there. Now, when you see a trend developing, a trend, whether it's an uptrend or a downtrend, only develops because a lot of traders are jumping on the bandwagon. And it takes a lot of energy to push a price up or push a price down. It takes a lot of work, a lot of trades. But it's like a locomotive. You ever watch the old Westerns where you see the train leaving the station and you see the head of steam building up and you see the wheels kind of turning and you hear the chuck, 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 and then it slowly goes up farther and gets faster and faster and goes around the bend and it's flying. Well, somebody once told me that a train traveling at 60 miles an hour needs 6 miles to stop. I don't know if that's mathematically correct, but a train can't stop on a dime. I mean, they can slam on the brakes and do everything they want to do, and most likely they'll throw the train off the track. So a train has to start losing some of its energy or cutting back some of its momentum way before it's ready to stop. So when the traders have started to chug away from that terminal, and we go chug, 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 and then we get ease, and they fill up that steamer again. It goes chug, 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 fill up the steamer again. Okay. At this point, it's chugging along nicely. I just want my little bit of profit that I see in my trend. Okay. Because at some point, I know that they can't apply the brakes and just go like that. It can happen. But when you have a well-developed uptrend or downtrend that is moving between support and resistance lines nicely, or going through those steps in the ladder, the floors in the elevator, if it's going to turn and drop like that, either something's going to happen on a fundamental level, or it's going to hit a support level or one of those steps on the ladder and fall. So as long as I can take my profit in between, I can enter a trade and exit. Now, a lot of people say, well, I waited for this well-developed trend to show itself. I could be waiting forever and a day and never get trading. Fact is, there's thousands of assets out there to trade. And well-developed trends happen all the time. Okay. Nice triangles happen all the time. But yeah, I've got lots of students who want to do 10 trades a day. I have other students that are scared to death to make any trades. I myself spend my whole day in the marketplace. And I used to be a trader in commodities. Now, even in those days, If I got one trade in a day, it was a lot, because I don't care how many trades I get. I care if I was successful or not for the day. So keep in mind, support and resistance are probably the most important pieces of information and what makes you better than the guy next to you. Because, yes, there are many ways to put support and resistance on your chart. You can use pivot points, which are mathematical calculations. You can use Fibonacci levels, which come from Fibonacci chart. Or you could do what I call eyeballing and go back and do the work and get the historical prices and look for the strategic prices where price hemmed and hawed in the past or hit quite often, because that's what's going to make you the best trader in the room, because your support and resistance levels are unique to you. So like when you look at my chart, okay, all of these levels, this is a Fibonacci over here, right? But all of these dashed and dotted lines are my support and resistance levels. They came from eyeballing. All of this on my chart. Now, what are these color codes? What are the dashes and the dots and the blues and the reds? They're personal. They are my personal key that I developed. I know how strong this resistance level was, or this support level was, whichever you want to call it, because it's steps going up and steps coming down, same steps. So when you go up and down the ladder. So it just depends on which direction you're going on the ladder. But I know how important that step was, how many times price reacted to that step. And even if you look in the current market situation, look how important this level has been every time price moved near it. Okay. So I know that that is a strategically important price level. Okay. And that's why I have it in blue. My reds tell me this is a very old level. Okay. My dashes tell me, I have my code. You need to set up your own personal ledger or key so you understand what you're looking at. Because like I said, these lines are drawn on there ages ago. Now, it has to be when the euro's trading at this level. It wasn't ages ago, because until it fell dramatically last year, it had never traded these levels. But they're still over a year old at this point. So they're very, very important to put on your charts. Okay. Volume. Now let's talk about volume. Volume is crucial because it lets you know whether your decision is supported by others. Because you know what, if there's no volume, or volume's not doing based on what you're doing the same thing, believe me, you're not the smartest trader and the only trader in the room. But let's talk about volume. Volume is what I guess we can call it an extrapolation. Volume, when you're trading commodities, and not in the CFD format, but when you're trading in the commodities market, or volume when you're trading the stock market, are exact numbers, because the stock exchange knows exactly how many shares of Google or Alphabet or Microsoft or Meta all sold, because they're all logged in and all go through an exchange. In a CFD market and the Forex market and the crypto market, there are no exchanges. So there is no real number. So the volume that you see on your charts today is based on the volume going through the major liquidity providers or market makers. Now, this doesn't directly reflect the global volume, but it's been tested that if volume increases with the major liquidity providers and market makers, it's not just jumping with these two liquidity maker pools over here and not with everybody else globally, because they're not being placed with those for one reason or another. So even though volume isn't a tangible number like you have in a stock exchange, it is a reliable number. So volume is important. And then lastly, with price action trading, is market structure. How well developed your trend is and what type of patterns you see developing. Like, for instance, like I said here, this was a beautiful triangle, absolutely beautiful. We got the breakout and it was perfectly tradable. Happens all the time. Okay? It's not a unique situation. Okay? So finding an asset that has push, ease, push, ease, push, ease, push, ease, a well-developed trend. Find one that has a chart pattern in there, and you find one that volume is supporting that decision. Hey, and this is a live chart. It's not that difficult. It's a matter of looking for these things. Okay. Now, I only trade a handful of assets. I trade the euro and its crosses. I don't trade stocks. I don't trade crypto. Not for any reason. I don't have any good things or bad things to say. I started trading the euro dollar a zillion years ago, and I added on to the other majors, and that's just where I stay because I know these like the back of my hand. It's up to you. But a guy, with a price action strategy, you could go technically from a stock market to an index, from an index to a crypto, because you're looking for a particular set of circumstances. And so that opens your range of assets you can be looking at. But remember, you're looking for basically 3 decisions. 1, sidelines. 2, are you going to buy or sell? 3, the price you're going to enter the market. And 4, at what price are you going to exit the market? Okay. So it's when do you want to take on risk, and when are you going to get out and turn that risk into profit? So there are several different types of price action strategies. Okay. In fact, in next week's class, we're going to be looking at a reversal trading strategy, which is basically a price action strategy. The key to any successful price action trading strategy is to remove peripheral noise, such as fundamental data. Okay. When you're looking at price, the only time first of all, everybody, and any smart trader, any good trader, always knows what's happening in the news, the headlines, on the economics calendar. I'm not saying trade them. I don't trade from the fundamentals, but I do want to know if the Federal Reserve is having a meeting and when it's going to come out and what time they're going to announce the interest rate. I want to know that that's happening today at 3 o'clock because I know it's going to create market volatility. Now, I don't know what it's going to do to the market. What I'm saying is I just don't want to be in the market when the markets get volatile because I could be forced in the wrong direction. I could take on a lot of risk, or I could get stopped out by these, huge moves in the market. So you always have to be aware of what is happening around you, but it shouldn't be taken into your price consideration, more into your timing. So when combined with good old-fashioned experience and a feel for the market, this could create an efficient investment strategy. Don't forget, even if you open a position based on any of the following price action trading strategies, you can also use the technical data to set stop loss limits. So one of the key aspects of price action trading when using support and resistance levels is the fact that once the support level is breached, it can turn into resistance and vice versa. Steps up the ladder, steps down the ladder. So it's only when you take the time to understand how like bar patterns emerge or triangles emerge and what they indicate that you can position your trades. Don't forget to also keep one eye on your stop loss limits. As you'll gather from the information, price action trading is based on the trends and momentum. The idea is simple. Once a trend changes the momentum, the momentum often grows. It's only when a stronger opposing trend emerges that the direction changes again. In other words, that locomotive chugging along, it takes a lot of energy. And when it's going to start losing momentum first to slow down the track. And it's going to start changing to go in the opposite direction. It's once that momentum is gone or is decreasing because it's got to slow down before it can turn. So in between these relatively strong trends, there will be huge periods of consolidation, sideways trading, and price will often bounce off support and resistance lines. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis and take them into consideration. However, price action trading offers the best of both worlds with both technical analysis and human input from the trader. So don't act with a trade until the market itself confirms your opinion. That's why we look at volume. Being a little late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. So many of the strategies we mentioned, what we've talked about tonight, some people say are overcautious. I believe in being overcautious. I work really hard for my money. I don't want to gamble. I don't want to be in Vegas. I don't want to be in Monte Carlo. I want to move the odds so far in my favor that I know I'm going to be successful, or if I'm going to lose, I'm going to only lose a little bit. You know, when I was younger, my dad and I would go to Vegas together, and usually with my mom. My mother didn't play cards. My dad and I played 21. And my mother would stand behind us, and every time we'd win a pot, I'm not talking about big gambling, I'm talking about little gambling, she'd steal a chip off the table. She'd tuck it away. Because inevitably, my dad and I would leave the table with no money. When we got back to the hotel room, my mom opened her purse, and she had tons of money in there because she'd been taking chips that we hadn't paid attention to all night long. So she was taking a little bit of this profit off the table. Okay. Because she knew we were not overly cautious, and she wanted to make sure we didn't walk away losers. And so there's a fine line of how much you're going to gamble and how much you're going to trade. And you always want to make sure you're prepared for false flags and other things that can be expensive losses. You want to make sure you have your stop losses. You want to make sure you understand you can't always make the wrong decision. So the basic difference between technical analysis and human input is what makes price action trading so effective. Effectively, you're monitoring emerging trends and reading these with varying degrees of discipline and experience. So price action trading makes trading easy. You don't have to be overcomplicated, because what are you doing? Sitting on the sidelines, deciding if you're going to buy or sell, at what point you're going to buy or sell, and at what point you're going to exit the market. You can make it oversimple. I want to spend more of my time monitoring risk, because the only time I have to monitor closely, my eyes have to be pinned to the screen, is between the open and the close. When I'm sitting on the sidelines, I don't have to once I book my profit. But when I've got risk on the table, I need to be monitoring, and then I want to use a lot of tools. So keep all that in mind. Think about price action. Simplify your trading decisions, and you'll find in the long run, you'll make better, more high probability trades. So thank you very much for joining us. Have a great week, and I'll see you next week when we're going to spend time learning the reversal trade setup and strategy using all of these things we talked about tonight. Have a good night and good luck with your trading. Bye now.